Friends, in this video for ITHOUGHTWEALTH, I'm going to talk to you on the topic, where are the SIPs going? Recent data tells us that the SIPs for the month of May are the highest in our history. So the SIP book has climbed to the highest, it's nearly 15,000 crores and growing. This data actually is completely different from the actual flows in mutual funds. Clearly, inflows into mutual funds have gone down by half even while SIPs keep climbing up. What does this mean? It means investors are showing a preference for disciplined investing into mutual funds. Systematic investing is seen as more acceptable by people even at a time when they are not putting in money into equities. This means that SIPs are here to stay and people are going to use it more and more to channel their monthly savings, to invest regularly and to grow their investment corpus in a systematic way. But the data, which looks very nice and strong on the outside, should also be seen from the inside. Where are these SIPs going? When you start looking at where the SIPs are going, then you start seeing it very differently. Firstly, SIPs are going very heavily into small caps. It's very easy to sell an SIP in small cap. In fact, you don't even need to sell it. People come voluntarily to buy an SIP in small caps. What is the reason for this confidence in small caps? The confidence stems from the fact that in the recent few years, from the bottom of COVID, small caps have delivered very high returns. So the anchoring is towards recent returns from that bottom. Also, when you look at the longer duration of time, it appears that SIPs have a higher potential to deliver returns or a potential to deliver higher returns or both. This means investors think that SIP in small cap is a natural choice and something they prefer over mid caps or even large caps. I know a lot of investors who have entire SIP plans only in small cap funds, 3 or 4 small cap funds. Mutual fund distributors find it very easy to sell SIPs in small caps. The belief is that this recent history of returns is sustainable for the future. While there could be a possibility of that playing out, it is not cast in stone, it is not certain. SIPs are also playing a very different role in small caps, and that is they are helping fund managers buy the same set of stocks at higher valuations, which in turn helps to sustain the valuation in those stocks, which shows the SIP returns in very glowing light. So it's something that is a product of SIP flows into mutual funds. Imagine the way you invest money itself is creating an impression that that investment is making high returns for you, whereas it is your investing that is causing that return. Now, this situation is in contrast with what is happening in large cap investing. People are not showing a preference for large cap investing through the SIP route as much as they are showing preference for small cap. If you are a professional in this industry, let's say you are a MFD, then you should look at your total SIP book, divide it into different products and see how much of sensitivity there is to the small cap SIP. Because if something goes wrong, then that SIP will stop, the investors won't be happy, and you will also be very unhappy because you will lose customers. If you are an AMC, then you must also evaluate how much of your SIP book comes from small caps. If it is very biased favoring small caps, then you need to build the other side so that there will be stability in your SIP book for the future, because stability is the key. If you are an investor, you need to understand how much of your money is going into small cap SIP and try to restore the balance between the different sizes of companies in your SIP. Have a predominantly large cap focus and keep your small cap exposure to the barest minimum through the SIP. I know all these statements are not popular statements. In fact, they are very, very unpopular things to say. But having seen what happens when you do SIP in overvalued sectors or teams, I feel that's the best thing one should do, which is try a safer approach and not do SIP in very, very expensive parts of the market. That clearly means you should not be an aggressive SIP player in small caps. I know what I am saying runs contrary to what you are hearing everywhere, but this is my view. And I would be happy to be wrong for your sake. But if I am right, then what you need to bear in mind is that you had this opportunity to take this conservative view when you watch this video. So, it's entirely up to you to choose a path which is conservative, safe, and invest lesser sums of money in the most volatile part of the market, or keep investing high sums of money, making your portfolio all the more volatile and vulnerable to any market correction. If you are someone who has made a lot of profit investing in SIPs, it's time to do an SWP, not an SIP. So, gradually withdraw some money from small caps and put it into large caps, maybe through an SIP. So, there is that option of doing an SWP from small cap and doing an SIP into large cap. I think it makes sense to gradually move some part of your money from a very expensive part of the market and migrate it to a part of the market where a broader macro driven economic recovery will benefit the most. So, these are all choices. Where you are sending your money is a personal choice, but make sure you send it to a place which is not overvalued, and make sure your money is not sitting in a place where any reduction in valuation will affect adversely. So, if these two things have to be aligned, you need to be very careful where your SIP is going, and you need to realign your SIP to the prevailing valuation trends in the market. Thank you for watching this video.